This is Rich Erwin, and it's 2 days after the national election. We thought it'd be a good time to give you a little bit of a post-election analysis of where we are now. I'm going to begin with 4 key insights from the election, and then share 3 conclusions and recommendations. The first insight is that this is the first time in history that a president has won re-election without an increasing majority. Neither party, in fact, has gained an edge. There is no mandate. Number 2, exit polls indicate voters want a grand compromise on the fiscal cliff. Washington will be under pressure to deliver on this. The greatest likelihood is for a temporary extension of the Bush tax cuts into the first quarter of 2013. At that point, the debt ceiling will be pressing as well. A solution may include $100 billion in spending cuts, discretionary spending cuts, some tax increases, and a framework for tax and entitlement reform. Third point, if progress is made, the country will be able to avoid recession and continue on a recovery path. With U.S. debt levels as a percentage of GDP currently higher than that of Europe, changes are urgently required, and Americans will need to recognize it will take an extended period of time. Deleveraging is expected to take 5 to 7 years. Yet the benefits will be clear as we move to a more sustainable growth path. And 4, market, business, and consumer confidence need to be restored. With problems fading abroad, a fiscal compromise has the potential to rebuild trust and optimism. Washington knows its reputation and record in history can't go much lower. Now that the popular electorate is split 50-50, it's possible politicians will attempt a bargain that will break the logjam. We sure hope so. Now I'd like to share with you our 3 investment conclusions and some advice. First, interest rates are expected to stay low for quite a while because of modest economic growth. Retaining excessive cash balances will result in lost opportunity and the inability to have inflation protection. We advise clients and investors to put cash to work in 3 to 7 year corporate bonds and stocks with dividends yielding higher than 2%. Second, tax rates rose from 1945 to 1968 and have since declined or remained level. You'll need to get used to tax hikes in the future. They've been down for quite a while. To cope with them, you might consider tax-free municipal bonds and investments with a growth component. And third, should the government reach a fiscal compromise, it will set off conditions conducive for equity appreciation. Current valuations are attractive. What's needed is less uncertainty. If the government establishes a clear fiscal path for the future, dividend stocks would appear to be a logical place to set up camp while waiting for the economy to gradually accelerate. Even if dividend tax rates rise, corporations have the ability to adjust their payouts to increase dividends to offset this negative effect. So all in all, we see the potential for better outcomes if we get less polarization in the nation and a recognition that an evenly split country is one that should compromise. Washington has an opportunity to lead the way. Our belief is we should all support even meager steps in this process. Progress will revolve around doing what's good for the country. That's what makes America great and can propel it toward a hopeful future. We'll be watching this process and reporting back to you in the future. Thanks for listening.